So everywhere you look, people are talking about the AI bubble popping.
I'm not optimistic on us working together to solve.
So what's the end? Is it a bubble that bursts eventually?
I think it is, yes. And
But if you go past the headlines, what you'll realize is that nobody agrees on what the AI bubble popping actually means. There's only three scenarios here. One is a normal market correction, stocks fall about 20%. Two is an infrastructure reset. So we have too much supply of chips and memory and not enough demand to meet that supply. Or three, we get that dot-com era 50% drawdown of the stock market, that generational apocalyptic financial event. And in today's video, we're going to be breaking down all three scenarios, and I'm going to be explaining why I'm not losing any sleep on any of these. Let's get into it. So let's start with the one that is almost guaranteed to happen, a 20% market drawdown. So market corrections of 20% happen all the time in the stock market. They were going to happen regardless of if AI existed or if NVIDIA was making chips or what was happening in the economy. You should expect a 20% market correction every 3.5 to 5 years. You get a drawdown of around 35% peak to trough. And it lasts about 9.5 months before it recovers. It's pretty standard. We've seen it consistently. If you look at the data from 1929 to now, so almost 100 years of data, it was going to happen. There's no avoiding it. It's just normal market business. It's how we clean out the books and get rid of the riffraff in the index. So let's talk about the infrastructure reset. Now, this one is actually very interesting. And this is the one that I actually spent some time thinking about. So if we'll look at the memory market. So there's three major players in the AI memory market. You have SK Hynix, you have Samsung, and you have Micron. And all three of these companies are making the high bandwidth memory that they use in AI clusters. And SK Hynix right now is on a 5-year plan to double their wafer capacity. And that sounds insane, but all of that additional memory is already contracted out. It's sold before it's ever being made. Micron is even more defensive than that. Micron is using the US CHIPS Act to fund most of their growth, and they aren't building anything until it's already under a long-term contract. And then if you look at Samsung, Samsung is actually retrofitting some of their old fabrications to actually build high bandwidth memory. And they want to combine the high bandwidth memory with AI ASICs so they can do both of those things on one site. Samsung is actually behind Micron and SK Hynix as far as high bandwidth memory production. And this is their strategy to try and bridge that gap. But also, they're not building anything without it being under contract. They are co-designing with their end user what the product's going to be and how much they need to actually produce. So if you look at it, how do you get to a place where you're oversupplied when everything is purchased before you ever build it? And the answer is power. So the power grid is the limiting factor here. You can get to a place where these three companies are ramping their demand, but the power grid is not ready to power on all those chips, all that memory, and it sits idle. The margins on these three companies collapse, and the overall market for AI hardware takes a very big hit. It will be isolated to the hardware players in the AI market, and the rest of the AI market and the AI trade will remain intact. And if you look at the delays that we're already seeing, the timelines are already getting pushed back like 30 to 50% from their initial timelines. So you can easily see a scenario in late 2027, early 2028, where this production from these three companies ramps and the grid is not available to actually support them. So I would put the odds of this actually happening at a coin flip. This is a 50-50 thing here, because if we can't figure out how to ramp the power with the memory and the hardware, you could easily run into that power grid bottleneck. So now let's talk about the scary one. The dot-com level collapse of the market. A 50% drawdown on the entire US stock market. And this one's interesting because if you invest in an individual stock, you almost have to expect a 50% drawdown at some point while you're invested in that individual stock. It's completely normal. And if you've held an individual stock for any period of time, you've seen this. In fact, on average, if you're holding an individual stock every 5 to 10 years, you should expect that stock price to cut in half. You should expect a 50% drawdown on that individual stock. And this is one of the main reasons people tell you to diversify and buy broad indexes, because a 50% drawdown event is extremely rare. They almost never happen. And the only way that you get there is not from a shift in sentiment. There actually has to be a macroeconomic trigger to drive you to that result. So if we look at the Great Depression from 1929 to 1932, we got a 90% drawdown. And the reason was a systemic bank collapse. And then if you look at the dot-com bubble in 2000 to 2002, we got a 49% drawdown on the market. And it was because the economy slowed down and there was a speculative bubble in the stock market. Those companies didn't actually make any money. It was a website with no product and no service. Then if you look at the global financial crisis in 2007 through 2009, it was a 57% drawdown, and it was caused by the credit system breaking down and doing those ninja loans to buyers who had no income, no jobs, no assets, and they got their homes foreclosed on. So what is people's thesis for why this scenario could play out right now? If you look at the concentration of the US stock market now, we're concentrated in very few names. The top 7 to 10 companies are driving the majority of the growth in the US stock market. And if you get a collapse in the demand for these companies, or the value in these companies drastically decreases in a short period of time, you could get a severe pullback in the market. And that thesis makes sense until you actually look at what these companies are doing. This is not 2000, where they're speculating on a website with no product and service and no path to profitability. These companies are some of the most profitable companies of all time. And if you look at their balance sheets and the legacy business models that are supporting these balance sheets, like search, software as a service, cloud, advertising, everything is backed by real income and real earnings. So the scenario where they just collapse overnight is not plausible. And like I said, you don't get these 50% level drawdowns in the market without some sort of macro trigger. So it would take some severe liquidity crisis, a global recession worse than 2008, a geopolitical event that breaks supply chains, and a complete loss of institutional confidence in the US equity market. None of these things have happened yet. Sure, we're taking shots on goal with the war in Iran and inflation, but right now there's still major inflows into the US stock market from foreign investors, and it's still the best place to invest for growth in the entire world. So I put the total odds of this collapse happening around 15%. It's pretty unlikely. Nothing to lose sleep over. And truthfully, I'm not worried about any of these scenarios hitting. And it's because what can happen after the scenario hits? So if you look at a normal market correction, a 20% drawdown, it recovers within less than a year. About 8 months, the market is fully recovered. So if you zoom out 1 to 2 years later, it's almost invisible on that chart. And then if you look 5 years later, the structural impact on the chart is completely negligible. You won't even see it. 10 years, there's absolutely nothing. You're still hovering around the historical averages of around 10% market returns. In fact, if you look at the S&P 500, you get a 5% drop in the year at some point, almost every single year for the last 40 years. You expect this normal level of volatility, and that's just part of investing in the stock market. Now let's look at like a protracted bear market, a 20% to 40% drop. And it takes about 17 months for this whole thing to play out. Market declines about 34%, economy slows, you got policy tightening, and there's an actual structural imbalance at play here. What's interesting is 1 year after it hits that bottom, you get a very, very aggressive recovery out of that bottom, usually in the order of 40 to 46% gains out of that bottom. And then if you go 5 years out after hitting that bottom, the cumulative returns are usually above 120% or more. So you get a very aggressive recovery. And then 10 years out after that bear market, you're going to expect average returns above the historical norm of 10% across that 10-year time frame. So it may take some time to recover, but if you're putting money in the market, if you're still in that accumulation phase, it's nothing to be concerned about because you're actually introducing an opportunity to grow your money faster than you would be able to in a normal market. These phenomenal companies are going on sale. The deeper the crash, the faster the recovery. Now let's look at the scary one, the generational apocalyptic financial event, a 50% drawdown of the US equities market. So this has happened a few times. The Great Depression was 90%. Stagflation of the 70s was 48%. Dot-com bubble was 49%. The global financial crisis was 57%. These are generally once in a generation events, and they tend to break things. They rewrite the market infrastructure and they reallocate all the capital from the speculative companies to the rock solid companies. And if you look at how long it took to recover after all of these crashes, so the dot-com bubble crash, it took between 4 to 5 years for everything to recover back to where you started. If you look at the global financial crisis in 2008, it was also about 4 to 5 years. And if you look at the Great Depression, that was substantially longer. It took about 15 years to recover to your initial value. But here's the thing. After that crash sets up some of the greatest bull runs in history. So the first half of the decade after these crashes, you're just trying to claw back to where you started. But the second half of that decade is very, very aggressive growth. It is some of the best wealth building opportunities of your lifetime. And in fact, the total decade return in general is over 200% or more across that decade. And the reason this happens is because you get compression of their price to earnings ratios. You have all these phenomenal companies that just went on sale, dropped from 20 to 30 PEs down to single digits or low double digit PEs, and you are buying them at rock bottom prices. You have set yourself up to make outsized gains across the next decade. So the thing about those 5-year and 15-year recoveries, they're assuming that you're not putting any additional money in. If you are saving for retirement and you are putting money into the stock market every 2 weeks, dollar cost averaging week after week, the recovery is much, much faster. The recovery cuts in half. So that 15 years, you actually recover in about 6. And you actually end up making a ton of money because you were buying all the way down, all the way back up. And by the time you hit even of where you started, you're actually way ahead. And you're set up for the massive growth on the tail end of that recovery. So if you are in that accumulation phase of your career, you should not be afraid of market downturns. You should want them because they give you an opportunity to build generational wealth in a way that the normal stock market does not provide. Buying at those all-time lows at peak fear is when you make the most money. So let's bring this all together. The first scenario, a 20% market correction, it's going to happen. 100%. There's no avoiding it. There's no getting around it. A 20% market correction is unavoidable. It will happen. It's okay. Just ignore it. It happens every 3 to 5 years. Scenario 2, the infrastructure reset. It's 50-50 whether this happens in late 2027 to 2028. It will be concentrated in the hardware names in the AI trade. You're looking at the memory, you're looking at the semiconductors. All of those companies are building out their supply in very defensive ways. They are worried about this boom bust cycle of being picks and shovels for the AI trade. And the only thing that's going to actually cause this to happen is the bottleneck of power. So keep an eye on power disruptions and delays in actually bringing data centers online, because if those start to mount, you could see an actual glut of chips and memory because they don't have power to turn them on. Their margins will rapidly decrease. These companies will get hit and they could drop 50% in value. But like I said, investing in individual companies, you should expect a 50% drawdown at some point. Doesn't mean they're bad companies, doesn't mean they won't recover. It just is normal business if you're investing in individual companies. If you're exposed to the broad market, you're not as concerned about this because the rest of the AI trade will be intact. These other companies will keep trucking along like business as usual. Then we have the dot-com bubble era style collapse, a 50% generational event to the stock market. This one is extremely unlikely. You need a macro trigger and you need weakness in the US stock market to converge at the same time to get there. Right now, we don't have that in the stock market and we don't have the macro trigger. And I would say that the US Fed and the policies that we put out now are a lot more geared to preventing events like this from ever occurring. So it's very unlikely. I'd put it at less than a 15% chance that it happens. And truthfully, in any of these scenarios, if you are in the accumulation phase of your career and you're investing money into the stock market on a bi-weekly or monthly basis, you should ignore all of this. None of this matters, because when the market goes down is the best opportunity to actually build wealth. You're buying things at a discount, and mathematically, that's your best odds of getting outsized returns in the stock market. And if today's video gave you some perspective on the AI bubble, what you should be worried about, why it may not be as big of a deal as everyone is saying, like the video, subscribe to the channel, because I'm gonna be trying to make you 1% better every day. Thanks for tuning in, and I'll catch you next time.
Understand the market, keep your vision on the prize, building up the wealth right in front of your eyes. Talk Higgins, yeah, we keep it moving. Talk Higgins, watch the wealth improving. Markets and the money, making sense of the math, helping you navigate the financial path. Talk Higgins, subscribe for the vision. Stay smart, stay invested. We out.